Relations Department at the IMF. And joining us here today is Tobias Adrian. He's a financial counselor and the director of the Monetary Capital Markets Department. Also with us is Fabio Natolici and Jason Wu, Deputy Director and Assistant Director of the Monetary Capital Markets Department. Now, before we turn the floor over to you for questions, I would like to turn to Tobias to begin. Tobias, we see there are some bumps on the road ahead of us, especially with sticky inflation in some advanced economies, amongst other financial stability issues. So could you set the stage for us on what challenges you see when you and your team put together this report?
Yeah, thanks so much. And I'm really excited to be here to see such an interest in our work. So let me first start with a baseline as a setting, and what we have seen is really a tremendous amount of optimism in financial markets. Our global baseline, as Pierre-Olivier explained in the previous press conference, is one of a global soft landing, i.e., inflation is expected to return to target in countries around the world, while economic activity slows, but we don't foresee a global recession in our baseline. So this optimistic scenario has really fueled asset valuations in recent months. We have seen that credit spreads have compressed even for riskier borrowers. So many countries that had been shut out of global capital markets for the past year or year and a half have returned to capital markets since the beginning of the year. Issuance has resumed, and valuations in risky asset markets, stock markets in particular, really have ratcheted up, but also in corporate bond markets and sovereign bond markets. Now, turning to the risks. So there are some short-term risks and some medium-term risks. The shorter-term risks are primarily about inflation and how persistent inflation is. So we do forecast inflation to come down, but there's certainly some differentiation across countries how quickly inflation is coming down and what central banks have to do going forward in order to get inflation back to target. So this is one risk, and that can certainly impact valuations across asset markets. A second shorter-term risk is that we do see a fairly compressed volatility, a fairly high correlation across asset markets, while fundamental uncertainty continues to remain somewhat elevated. So there are certainly geopolitical tensions around the world, and there are other economic headwinds that could lead to a reassessment of the economic situation going forward. So this sort of wedge between financial market implied volatility and uncertainty in the underlying economic performance is a second issue that we flag. A third issue is about this narrowing of credit spreads and underlying credit quality that is deteriorating in some corners. So broadly, the global economy is very strong. It has surprised to the upside in many countries, particularly in the US, but also just yesterday, China announced stronger than expected GDP numbers. So we see a lot of strength, but we do see certain corners where default rates are rising, where there's some weakness. And so this tension in between, credit spreads that are really narrowing, but some struggles in some corners is a third short-term risk. In the medium term, it's really about the buildup of vulnerabilities. Already the level of debt has come up globally since the pandemic. Governments have stepped in aggressively to cushion the economic fallout from the pandemic. And as a result, we really see sort of like debt to GDP fairly high. And as financial conditions have eased, there is leverage that is rising again in many corners of the financial system. as well as the non-financial system. And that's certainly something we're watching very closely. So let me stop here and turn back to Mara.
Thank you, Tobias. So I just wanted to say you can ask your questions also via WebEx or via the press center. And when you raise your hand, can you please, if I call on you, just identify yourself and your outlet. Okay, the lady here on the red. Wait, just one second. We're just getting you the mic. Thank you.
Thank you so much for the opportunity. My name is Ray Zhou from 21st Century Business Herald, Guangdong, China. So we have a first question. Given China's important role in global economy, as well as you just mentioned, China just announced stronger than expected GDP growth in the first quarter. So can you elaborate a little bit more on China's role in promoting global financial stability as well as other economic activity? Thank you.
Thank you. Before we turn to Tobias, are there any other China questions in the room? I see a gentleman here in the front.
Yeah, I guess my name is Jason. I'm with Tencent News from China. So I guess my question is also, following up always the lady here. So can you talk about China's, the role in maintaining its domestic financial stability and really contributing the global financial stability? Thank you.
Thank you. Any other questions on China? No. China? Okay. The lady there? Thank you.
Olena Krasdan, Ukraine's the page, but my question regards China. Quite a few years ago, there was a fear that China's development credits may be a risk for the financial stability. And I want to ask, we have just heard on the World Economic Outlook that we have the weakness from the property sector, and the stimulus from the government doesn't work as effectively as it's believed to be. And I wanted to ask, is there still a risk of China's development market and real estate market to become this bomb for the financial stability as we thought several years ago?
Thank you.
Yeah, thanks so much for your interest in China. Of course, China is the second largest economy in the world, so we are following very closely what is happening in terms of financial stability. Let me start with a big picture, and then Fabio can go a little bit deeper on the financial sector issues. So, as you noted, and as I noted already, the most recent GDP figure was above expectation. Last year, for the whole year, GDP growth was also above 5%. So the overall growth rate remains, very strong. Now, the challenge that all three of you alluded to is really from the property sector. And I would distinguish two aspects that are very important. So the first one is that investment in the property sector has been an engine of growth for China for many years. And there is a marked slowdown in property investment, in particular when you look at new construction and housing that has dropped very, very sharply. And that is certainly a transition in terms of the growth model that authorities are very focused on. A second aspect is about the valuation of housing prices. And we have seen a decline in housing prices, but is fairly moderate to date. And that is certainly a strength from a financial stability perspective. Housing investment is the biggest asset for most households. And of course, banks have exposure to the housing market as well. So while there has been a decline in housing prices, it has not been extremely sharp. So most of the adjustment is in quantities, less so in prices, and that's a plus for financial stability. Now, in terms of assessing financial sector stability, it's very important to consider the regional heterogeneity of housing markets. So there are some major cities that continue to perform very strongly from a housing perspective, while other provinces are somewhat weaker. And so we certainly see also this regional disparity in terms of the banking sector. So some of the smaller banks in some of the weaker provinces are more impacted than, say, banks in the stronger provinces. So let me turn to Fabio to elaborate a little bit more on these issues.
Maybe what I can do, I can walk you through the different possible channel of contagion that we had in mind when we assessed the financial stability situation in China. The starting point is that confidence still not been restored, despite some measures that have been taken, like lowering mortgage rates or easing the access to purchases. We have not seen a bottoming out in the sector. As Tobias mentioned, prices are not declined as much as other historical episodes, like comparing to the US subprime crisis, for example, but activity have, like so sales and other measure activity investment. Even the prices, you can see a differentiation between new prices and existing prices. Existing home prices actually decline much more than new. That less decline of new prices help banks absorb some of the shock in a more manageable way, but at the same time has been an impediment in restructuring. And you see this issue about confidence in the property developer sector. The access to markets has declined, both banks and non-banks, and even the sources of pre-sales revenues coming down. That implies that they have less ability to complete projects. Less ability to complete projects means there's less revenues from land sales, and that it's a channel of contagion to the local governments, where for the local government funding vehicles, so the structure that are used to finance investment, they have a wall of maturity coming in, and there's a clear differentiation to the biggest point between, for example, weak provinces and strong provinces. Another signal in terms of the limited bottoming out of confidence is in the equity market. From peak to trough, the equity market is down about 45%, despite recent incline. And that's another channel of transmission to the wealth management product sector, for example. So the non-banking financial institution, that sector is pretty large. It's about 110 trillion RMB, or 90% of GDP. We have seen the equity-linked funds that actually have lost quite a bit of value, and the trust funds, obviously, that's more linked to the real estate. But also the concern now is for the more wealth management product. Those are more tailored toward retail investors, and they tend to own about 80–90% in fixed income. So the concern is that if there is losses in those funds, retailers could withdraw money. That implies, because they hold significant portion of corporate bonds, that corporate bond yields would increase, and that could be a channel of transmission to funding markets to the banks. So those are some examples of possible transmission channels. So the policy recommendation, as Tobias has mentioned, is a mix of addressing macroeconomic, if you want, strength, as well as the more structural reforms.
Thank you. Thank you, Fabio. Okay, the lady here right in the front.
Thank you, Laman Zainalova from Trade News Agency, Azerbaijan. My question is about the Caucasus and Central Asia region. As you know, these countries are very reliant, heavily reliant on commodity exports, and given the fluctuations around the world in the commodity markets, how does IMF forecast the financial stability in the countries of this region, and what are your recommendations in order to make those countries less vulnerable in the face of the external shocks? Thank you.
Yeah, thanks so much for this very important question. And I would recommend two main avenues here. So the first one is really about financial sector policies. We are regularly doing financial sector assessments in countries, including in the region, where we really look at the financial stability in the country, the strength of financial sector oversight, as well as the kind of emergency measures that the countries could deploy if adverse shocks were to hit. So this is deposit insurance, emergency lending, and resolution powers. And we provide very detailed assessments of the strength of financial sector policies. And in all of our FSUPs, we have a number of recommendations, and following those recommendations is really our number one priority for country authorities. So that is really on the financial sector side. Secondly, in terms of monetary policy and macroeconomic frameworks, of course, some countries in that region have more fixed exchange rates. Others are inflation targeters. So it depends a little bit what the exchange rate regime is in terms of policy recommendations. But for those that are either inflation targeting or heading towards inflation targeting, using the exchange rate as a buffer to absorb shocks is certainly a priority. We are also providing, granular advice to authorities in this respect.
Thank you, Tobias. Yes, the gentleman over there in the third row. Yes.
Alex Brummer from the Daily Mail in London. I want to ask about two asset classes which we haven't discussed very much. Firstly, why do we think at the moment the gold price is so strong? Because equity markets and other markets seem to be very healthy, and normally the gold price goes in the opposite direction. That's the first. And secondly, do we think that Bitcoin might pose a systemic risk in any kind of way to the global economy?
Yeah, thanks so much for those important those questions about the two important asset classes. So, indeed, the gold price has reached historically high levels, and Bitcoin has fluctuated, but also reached historical highs earlier this year. So let me start with gold. We see two drivers here. So one is certainly some reallocation of reserve asset managers towards commodities that include gold, and that could be one contributor to those valuations. The second one is, of course, a speculative behavior. As I pointed out at the beginning, volatility in financial markets is fairly compressed, but of course, deeper economic uncertainty still remains fairly high. Geopolitical uncertainty remains high, and gold is oftentimes viewed as a kind of hedge against those broader geopolitical risks. In terms of Bitcoin valuations, of course, it is difficult to pin down the fundamental drivers of Bitcoin valuations. One technical factor that has played a role is the development of ETPs, so exchange traded products that have been allowed in the US. So when you look at allocations to Bitcoin since the beginning of the year, there's certainly been a substantial inflow in those investments through the ETPs. I don't know, Jason, whether you want to compliment me?
Yes, I think in this regard, our view is the authorities should encourage and monitor the regulated entities on the exposures, both to the cryptocurrency itself, as well as some of these derivative products that, like ETPs that Tobias has mentioned.
Thank you, Jason and Tobias. Do you want a follow-up? Wait, we need a mic here.
Oh,
Please.
so the follow-up question was whether it poses a systemic risk. So we don't see it as a systemic risk at this point, but we do view it as a risk and as a potential risk going forward as well. So the IMF has worked closely with the Financial Stability Board to develop a policy framework for crypto assets. And this includes a regulatory approach as well as a broader macroeconomic policy approach. And we're currently rolling out those policies. And the goal is really to make sure that crypto assets are regulated and are embedded in a policy framework that contains any broader fallout for the financial system or for economies. So containing systemic risk is certainly a policy objective of this initiative.
Thank you, Tobias. Yes, the lady right here in the front.
Thank you for taking my question. I'm Marlene Shong with Xinhua News Agency. I want to ask about the U.S. Federal Reserve, because right now there has been some inflation surprises in recent months, and maybe the Fed would consider delaying its rate cut. And if interest rates are held higher for longer, how do you evaluate the impact for the global financial market? Thank you.
Thank you. So just on that question, we have another question that came in on a similar topic. Pablo Pardo from El Mundo, and he asks, in case the Federal Reserve delays its monetary easing, what would be the impact on the US financial system?
Yeah, those are, of course, very relevant and very timely questions. So let me start by pointing out that the U.S. economy has performed very strongly since the pandemic. It has grown extremely well, and there are a number of factors for that. Productivity growth has been strong. There has also been labor force participation that has increased. So a lot of the variation in interest rates is really reflecting the strength of the economic performance in the US. So interest rates, longer term interest rates have indeed increased in recent days. And it's a combination of surprises for inflation, but also surprises in terms of economic fundamentals. That may have implications for monetary policy. Our forecast remains that inflation will return to target, and our expectation is that the Federal Reserve is going to start cutting at some point, but how many cuts and the exact timing is certainly data dependent.
Maybe a couple of things to add. One, a slightly different way to answer the question. It depends on what the US economy does. So if interest rates remain high because inflation progress is stalling, but the economies continue to grow strong, that's a positive backdrop. So if you think of like how equities are valuated, if earnings remain strong, even if interest rates are rising, there could be less of an impact. The concern we had in the GFSR would be one where the central banks, because inflation is stalling, keep rates for longer. It has an impact on the asset price more broadly, in line with a possible decline in economic activity. That would have a much more meaningful impact on asset price, I think. There is also a second way to answer is there's a sectoral aspect to this. So, and I can pick an example, which is commercial real estate. Commercial real estate is an example where there are about $1 trillion just in the US coming due in debt over the next year. The estimates of a gap there, it's about 300 billion. And we start seeing already, despite the economy being strong, a deterioration in asset quality. You can see in default rates in the commercial mortgage-backed security market, you can see in charge-off for banks. And that's specifically a weak tail of banks, the regional banks, that is more exposed to commercial real estate. So we look at various features of those in terms of exposure to commercial real estate, in terms of holding of securities. That was the cause of the crisis in the banking sector last year in the US. That's about 475 billion of held to maturity asset, for example. So where rates end up is going to have an impact there. And so if you look at through the sectoral lens, so there's also an impact on different sectors. It's going to be different depending on where the sector is in terms of health.
Thank you. So I just wanted to stay on this topic because we got yet another question from a reporter for Forbes Mexico, Sylvia Rodriguez. She asks, what are the biggest challenges that emerging economies like Mexico will face in the face of a much slower decline in interest rates in the United States than expected?
Yeah, let me start, and then perhaps Jason can complement me on the impact on emerging markets. So there are really two ways to think about that. So we have certainly seen an appreciation of the US dollar in recent days as the US economy has performed very strongly, and that continues a trend of strong performance of the US economy. And so a stronger dollar can translate into tighter financial conditions under some circumstances to some of the emerging markets. Having said that, there is a second important point to consider, which is that the strength of the US economy also has positive spillovers on emerging markets such as Mexico. So demand from the US may be stronger, and the easing of financial conditions more broadly can also be transmitted. So the net effect can actually be positive or negative. So just looking at the exchange rate is probably not sufficient. Jason, do you want to add on that?
Sure, Tobias. Thanks for the question. Let's first recognize that many emerging markets have been quite resilient throughout the past 2 years in the face of repeated global shocks, including interest rate hikes. One of the reasons why this is the case is because of improved policy frameworks, and some central banks haven't moved early. So, in light of potential higher for longer, particularly in the first scenario that Tobias has outlined, emerging markets will surely be tested again. Here, it is important for them to maintain appropriate policy frameworks in order to build buffers, both in terms of the monetary, on the monetary side, as well as more medium term on the fiscal side as well, in order to preserve this resilience. We should also probably recognize that there's a large differentiation across emerging markets. In Latin America, the policy differential vis-a-vis the US in terms of interest rate differential is still positive, but in some other regions, that policy difference is diminishing. So there could be a differentiated impact on emerging markets if we were to continue on in a higher for longer world.
Thank you. Thank you, Jason. I see, Marion, you had a follow-up on the US dollar.
Hi, I'm Mehreen from the Times. Sorry about my hoarse voice. Just to follow up, given the risks of sticky inflation in some countries and inflation falling in others, there's a risk of monetary divergence. Are you calling on central banks to try and coordinate their loosening to limit the potential for financial volatility? And if they don't want to coordinate, what are the risks of divergence, and where could we see the channels for that risk being transmitted inside financial markets?
Are there any other questions on a similar vein? Talking about sticky inflation and dollar. Okay. The gentleman in the front, please. Excuse me. Right here, the gentleman in the front. Thank you.
Thank you very much. Shu Takaoka, working from GG Press, Japanese news agency. Not only emerging market, but also Japan advanced economy have some pressure from appreciation of US dollar. And what is your view on that point? Could the FX market volatility pose some risk at the global level?
On the US dollar, okay. Quite a lot of interest in the US dollar here. Okay.
For that context. My name is